private crypto company has quietly become one of the largest gold buyers on earth. It's not a central bank, it's not a sovereign wealth fund, a stablecoin issuer, and it is reshaping the gold market at the very moment central banks are preparing for a new monetary world. The real question is not whether gold has been lifted by Tether's buying, but what it means when the world's oldest safe haven becomes entangled with the newest source of synthetic liquidity. If you bought gold because you wanted to step away from the financial engineering, the story that has emerged in recent weeks may be giving you reason to pause. Gold, which investors value precisely because it refuses to participate in the theatrics of modern finance, now appears to be partially influenced by one of the most prolific creators of synthetic liquidity in the entire digital ecosystem. Tether, the world's largest stablecoin issuer, has quietly become one of the more significant marginal buyers of physical bullion. Now, according to analysis circulated by Jefferies and echoed by the FT, Reuters, and CoinDesk, the company now holds roughly 116 tons of gold. This places it beside several smaller central banks in scale, and it's particularly striking given the pace at which the accumulation has occurred. In the third quarter alone, Tether accounted for nearly 2% of global gold demand and between 12 and 14% of central bank purchases. Now, in a market that is moved by marginal flows rather than big narratives, such buying pressure is unquestionably influential. But the question is not whether these flows have lifted the gold price. The real question is what it means when the supposed anchor of the monetary independence becomes entangled with a privately owned issuer of a $170 billion digital IOU. And this is a company that has previously settled with the United States regulators after admitting to misleading statements about its reserves, and that now claims to hold vast quantities of gold in a Swiss vault whose precise location it chooses not to disclose. Now, for an asset prized for its independence from other people's balance sheets, this juxtaposition is quite difficult to ignore. Once one steps back from the marketing language of tokenization, the contradictions become clear. Tether presents its new token as a modern, frictionless alternative to traditional bullion. The associated documentation tells a different story. It describes a structure that in many respects carries more risk than the physical gold that it seeks to represent. Now, set against this, the behavior of the gold market becomes more complex. The recent rise in the gold price has been driven by familiar forces that include fiscal deterioration, geopolitical fragmentation, and a broad realization that many advanced economies lack the political capacity to restore their balance sheets. Yet, when a private issuer with a history of opacity begins to behave in ways that resemble a highly leveraged central bank, the gold market inevitably absorbs some of the operational fragility associated with such an actor. Now, should confidence in Tether weaken, should regulatory authorities intervene more aggressively, or should stablecoin flows reverse, the company may be compelled to sell assets to meet redemptions. Now, that scenario would introduce precisely the kind of reflexive risk from which gold is supposed to offer protection. However, if one were to stop the analysis right there, then the story would be incomplete. Tether is not the dominant force in the gold market. It is a newly visible anomaly that captures attention because its presence is novel. The structural drivers of the gold market lie elsewhere, and they explain far more of gold's behavior than any private digital currency ever could. Now, central banks are the real foundation beneath the gold market at the moment. Their purchases have reached levels last seen in the early 1970s, and they have been executed with a consistency that suggests a strategic reassessment rather than a tactical move. These institutions are responding to a world in which the assumptions that supported global finance for half a century are no longer secure. Trust in custodial neutrality was weakened when a major sovereign's reserves were frozen during geopolitical conflict. Confidence in political continuity has been challenged by repeated fiscal crises. The expectation that foreign-held assets are immune from the political actions of host nations no longer carries the weight that it once did. In this context, gold has regained its position as the only form of reserve asset that does not transmit the risks of another state. Central banks are buying gold because they want a portion of their reserves to exist outside the discretion of any foreign power. They are also repatriating gold and expanding domestic storage capacity because they understand that sovereignty and custody are inseparable. Analysts describe this behavior as inelastic because it is defined by a predetermined need for ounces rather than a view on price. Weakness encourages accumulation, and strength does little to dampen demand because gold is functioning not as an investment, but as a structural component of the national balance sheet. This behavior becomes even more striking when one considers countries such as Japan, Singapore, South Korea, and the United Kingdom, all of which hold comparatively low allocations to gold relative to their peers. Should even a subset of these nations choose to raise their gold holdings to levels that resemble those of the United States or Germany, well, the incremental tonnage required would exceed several years of global mine supply. And it is this structural imbalance, rather than the activity of any single private buyer, that defines the long-term outlook for gold. Nevertheless, the emergence of Tether introduces a new category of demand, if you like, that the gold market has not encountered before. Traditional drivers include jewelry, futures markets, exchange-traded funds, and of course the official sector of central banks. Tether's presence sort of adds a kind of fifth force that does not behave really like any of these. It's neither sovereign nor cultural. It's not driven by macroeconomic expectations. It is the byproduct of balance sheet expansion within a privately issued digital dollar system. And this new factor complicates short-term movements because it has the capacity to tighten the physical market without reference to the variables that usually guide gold demand. Yet it does not alter the long-term trajectory because the long-term trajectory is determined by sovereign institutions that operate with horizons measured in decades rather than quarters. In this environment, the most rational choice for investors who want the protection that gold offers is to focus on the form of ownership that does not depend on solvency, governance, or software of any intermediary. Fully allocated, fully segregated gold held under clear legal title remains the most robust expression of monetary independence. It does not rely on corporate discretion. It does not rely on redemption terms that can be changed. It is simply gold, held in one's own name and insulated from the vulnerabilities that characterize both digital assets and fiat currencies. Gold's enduring strength lies in its simplicity. It does not respond to quarterly performance pressures. It does not need validation from any algorithm or institution. It's inert and it's unambitious. It's without yield and without promise. And it is this very lack of excitement that has allowed it to survive every monetary experiment of the past 5,000 years. The temptation to reinvent gold through tokenization ignores the fact that its value comes from its refusal almost to conform to the logic of systems that are themselves unstable. So has gold been tethered? Well, in a superficial sense, one could argue that a private issuer now influences the market at the margin. The deeper reality is that gold's center of gravity has moved decisively towards sovereign accumulation because governments themselves are preparing for a world where neutrality, stability, and custodial independence matter more than ever before. Tether may add noise at the edges, but it is the quiet and steady behavior of central banks that defines the signal. Gold is not rising because of what a stablecoin issuer is doing, but because the institutions that understand systemic fragility most acutely are securing the one asset that belongs entirely to them. And that is that gold endures, that it is the gold worth owning.